Welcome to today's session. My name is John Versace. I'm the head of Expat Services here at Apt Wealth Partners. I'll welcome my colleague, Emily Lanciana. Welcome, Emily.
Hi, everybody.
So today's session is all about investing in Australia as a US Australian taxpayer. So whether you're a US citizen living in Australia or an Australian living in the US, there are a lot of things that you need to be really careful of when investing in Australia. So we're going to go through some of the do's and don'ts that you need to be aware of, and some potential things to think about in your financial strategy. So I'll just skip through to the next slide. Just bear with me as I do this. Screen's playing up here. I'll go through just some of the formalities initially. So today's session is recorded. So if you need to jump off the session today, please feel free to do so. And you'll get an email in the coming days with a copy of the recording, and you'll be able to review that. There's also a Q&A box at the bottom of your screen there, so please feel free to ask any questions along the way. We'll try and get to as many of those questions as we possibly can. In these sessions, though, it's often a tricky thing to get to everything. We'll do the best we can to get as many questions, and we'll give you the ability to communicate with us following the session as well. There's a lot of ground we're going to cover as part of this presentation as well. So we'll try and be as specific as we possibly can, but obviously, this is going to be very general in nature, and we're going to be touching things at a very surface level. Feel free to ask more specific questions in the Q&A, and we'll try and get to as many of those as we possibly can. And just reiterating that point there, as we always do with these sessions, we need to confirm that this advice and this session today is general in nature. We haven't obviously considered any of your personal circumstances today, so please don't treat this as a substitute for any personalised advice. If you are seeking personalised advice, please feel free to reach out to myself or Emily or a suitably qualified professional. So very quickly, we'll just give you a quick snapshot of Apt Wealth and Emily and myself before we jump into the content today. So Apt Wealth is a broader financial advice firm. We've got offices in Melbourne and Sydney, and a small office down in Geelong in Victoria. Been around since the early 1990s, just over 30 years in operation, and we look after around $3 billion on behalf of our clients. So we're one of the larger firms in the Australian advice space, and we look after holistic situations, and we've got ongoing relationships with our clients. So we unfortunately can't do one-off type advice, but we're there to set up the best strategy that we think our clients should deploy to achieve their full financial goals. And then we're there ongoing to regularly check in, make sure our clients stay on track and continue to make good, smart decisions. And then the specific division that Emily and I are a part of is the cross-border services team, which is a specialised team that looks at cross-border individuals that either have assets or cross-border tax needs, which is obviously most of you on the call today. The majority of our clientele that sit within the cross-border services team are US Australian taxpayers, because as I'm sure you're all aware, and if you're not, you're about to be aware that there are some real big complexities of how to navigate US Australian taxes, and you need to do things a little bit differently to how you would if you were just a regular Australian managing your wealth here in Australia. Very quickly about me, so I'm a director at Apt Wealth and a head of head of Expat Services. So I've had a 20-year career in the financial and wealth management space, and my particular specialty is around expats, US citizens living in Australia and Australians living in the US. It makes up a very large majority of my clientele, and something I've had a lot of experience in navigating. I'll throw over to Emily to introduce herself.
Hi, everyone. I'm a senior advisor and partner at Apt Wealth Partners. I've been with Apt for 8 years, but in the industry for 14 now. And now my focus is on providing specialized expat advice to clients, specifically, like John said, in that US Australia space.
Beautiful. Thank you. So, um, to kick off the presentation today, it's always a question we have from our clients of what should they be investing in and how should they consider investment. So these are the high level things you need to consider when starting to think about how you invest. You know, this is where you start. So really looking at your risk tolerance and stage of life. So what are you trying to achieve from your investment, and ultimately how much volatility in the underlying asset are you looking to undertake? And we do a lot of work with our clients to determine what their risk tolerance is, and how to invest according to their stage of life. As a general rule, as you're younger and have more time to ride the ups and downs of investment markets, you might be a bit more aggressive than as you get to retirement and funding retirement. So that's an important factor, but it's not that simple. That's something that really depends on the individual as well, and whether you can sleep at night with the ups and downs of asset markets. And that's something we help our clients determine based on many factors. But that's an important consideration: is the risk you're willing to take. And part of our role is to try and help you mitigate a lot of that risk and be sensible with investment. Access to capital is really important. When are you going to need to access the money? Usually we are investing for some sort of future goal. When that goal will be and how liquid or accessible you need the money to be is going to be very important. So that's an important consideration. So, for example, if you're funding kids' education and you need access to lump sums, a property is probably not appropriate. It might be looking at an account that you can readily access and sell down the capital to fund kids' education. So that's an important consideration as well. Now, more specific to the people that are tuning in today, these last 3 points on the slide there. So importantly, it's navigating US and Australian taxes. So we do see a lot of people get tripped up by really only thinking about one of those jurisdictions, but not contemplating both. So, for example, if you're living in Australia and listening to your Australian friends that don't know anything about US taxes, they might recommend to do a certain strategy that makes sense from an Australian perspective, but can be a complete disaster on the US tax side of things, and vice versa. So if you're US or Australian living in the US, if you're just listening to US advisors and just listening to your American friends, there are things that make sense from an American perspective, but maybe really complicated when you get back in the Australian tax system. So it's very important to understand how you're going to be impacted on both, and we're going to dive into a lot of these concepts and considerations, looking at both angles through the session today. The fourth point there, what is your purpose for investing and where will these goals take place, is very, very important. So we work with a lot of US Australians and they're thinking about, should I be investing in the US? Should I be investing in Australia? And that's a difficult one to answer sometimes, but what it often boils down to is, where do you think you're going to be utilizing that money? And ultimately, we're investing for a future purpose. So where is that future goal going to be taking place, whether it be retirement, whether it be buying a house, whether it be kids' education or any other goal? Is that going to happen in Australia or the US or another destination in the world? And that isn't the be all and end all, but it is a big factor in where you should be investing. And the fifth point, and the reason why is because that fifth point, importantly, is the currency exchange risk side of things, in that if you are looking at, for example, you're an Australian living in the US and you're thinking about buying a house in Australia in 3 or 4 years' time, and you're building all the resources to buy that house in the US and in US dollars. If the Australian dollar really strengthened and the US dollar really weakened, then your resources that you're going to have to bring back to Australia may be lessened. And that's where the currency exchange risk comes into this. And it's a really important consideration in deciding where you should invest and what you should invest in. We'll talk a bit more about this through the session today, but it's all these things on your screen are very important considerations in how you manage the risk. So, passive foreign investment company. So this is a concept that is often missed from US Australians when investing in Australia, and it's a really important area to look at. So I'll throw over to Emily to go through what a passive foreign investment company or PFIC is and how US Australians should be thinking about it.
Yeah, perfect. Thanks, John. So if you have ties to the US, so including an Australian citizen living in the US or US citizen or green card holder living in Australia, you are limited by the types of investments you can hold when you are investing in Australia. So specifically, you'll need to avoid passive foreign investment companies, also referred to as PFICs. So what is a passive foreign investment company? It's a foreign corporation to the US that holds 50% or more of their assets in cash or securities, or 75 or more of their income is generated from passive sources. So, for example, interest, dividends, or rent. So, examples of PFICs include exchange traded funds, stapled securities, listed investment companies, managed funds, and real estate investment trusts. Now, some people will know why, to avoid passive foreign investments, but we don't really know why. So the reason why we don't hold passive foreign investment companies is that there's additional filing costs when completing your annual tax return. So a separate filing is required for each PFIC that you do hold in your portfolio. And generally, you would also be taxed on the increase in value of the investment each year, regardless of whether it's retained or sold during that tax year. It's a really complicated tax calculation, and is generally treated in a number of different ways, but it will negatively impact your tax position if you do hold these. So how do we avoid passive foreign investment companies while investing in Australia? So we can do a number of things. So by investing in Australian direct equities, US domiciled exchange traded funds, or investing solely in the US. Now, a lot of people might be thinking, based on this information, it might be best just to invest solely in the US. However, something that John touched on a little bit earlier, that currency exchange risk adds an additional layer of complexity and risk that actually might make it more beneficial to invest in Australia, despite the passive foreign investment company complexities. So I'll go into what currency exchange risk is in terms of a definition, and then move into just discuss why it's important that we try to minimize this. So, currency exchange risk refers to the risk that the value of a particular investment will be impacted by an adverse movement in currency exchange rates. So, in order to reduce currency exchange risk, we need to go back to what John also touched on earlier about determining first the purpose for investing and where you're planning to use the capital. So, for example, if you're planning to retire in Australia, we generally recommend growing wealth in Australia because that's where you'll need your capital long term. That's where you'll be accessing those funds. So therefore, if you're planning to return to Australia after living in the US, investing in USD or in the US, despite the investment complexities, you may actually increase the risk within your portfolio. So you may be better off bringing that money back to Australia at regular intervals. So we often suggest monthly or every couple or few months to reduce that currency exchange risk. So very similar concept to dollar cost averaging with investments, which I know a lot of people are aware of that particular strategy, which is where you invest at regular intervals to reduce the impact of market volatility by spreading out the risk over a period of time. So same concept with currency exchange risk, moving the funds back to Australia at regular intervals to reduce that currency exchange risk. Perfect.
Excellent. Thanks for that, Emily. Yeah, so very, very important concepts to be aware of and factor into your thinking when selecting investments, and that's something that we help our clients with. And certainly the passive foreign investment company, try and look to avoid that where we can. The next area we were going to touch on is Australian property, and how is that treated from a US Australian tax perspective. Now, it's very complex, and we're dealing with Aussies living in the US at the moment and US citizens living in Australia. So we'll try and do our best to delineate and work through how that would work in the different scenarios. But I guess a few concepts to be aware of, first and foremost, is that there is a double tax treaty between Australia and the US, and it helps to avoid at a federal level double taxation. So it means that if you pay some tax in Australia on income or capital growth from a property, then if you're liable for US taxes at a federal level, that'll be offset. So an Australian property, Australia is going to get first taxing rights to that. The taxes you pay in Australia can then be used to offset against your US tax return in most instances. Now, important to note that if you are a resident of a US taxing state, where there's state-based taxes, somewhere like California, for instance, then that may be an additional tax on top of the federal taxes that you paid in the US or Australia. So, for example, if you're selling a property in California and it's an Australian property, there may be Californian and likely to be Californian taxes that go on top of the federal taxes. So that's something to be really aware of, and something that unfortunately we've seen some Aussies living in the US get tripped up by. So, but there is a double tax treaty between US federal government and Australian federal government that helps mitigate double taxation. Now, this other concept of debt repayment. Now, often we are funding property in Australia through debt, which can be an effective strategy and is a strategy that many people deploy. But you've got to be very careful on making lump sum repayments on an Australian debt when you're paying US taxes. Now, it's a very weird concept to explain, and often one that gets missed, and it may not always be applied by accountants, but this is certainly an area to just watch out for, is that if you, and I'll explain it using an example, if you have a $1 million loan against a property in Australia, and let's say that you keep the interest repayments as interest only, so you're not actually paying down the principal. So the $1 million in Australian dollar terms from day one stays the same through the life of the loan, just for the simplicity of the example. And again, for simplicity of the example, let's assume that it's dollar for dollar between the US and Australia in the exchange rate. So 1 Australian dollar equals 1 US dollar. Now, and that's when you take out the loan. So when you go to pay down the loan in 5 years' time, let's assume that the Australian dollar value of the loan is still $1 million, but the US dollar value of the loan has gone down to $750,000 because of the currency exchange movement, and not through repayment of the loan. Because of that perceived benefit from the currency exchange side of things, there can be a tax if you were to make a big lump sum repayment of that loan to the US of the difference between where you started with the loan to where the loan was when you made the repayment, of that $250,000 difference, which can be a taxable event with the US, something that you should just check with your accountant before making a major lump sum repayment on an Australian property, because it can be an unexpected and unwanted tax event. And it's one of the ones that is probably one of the worst things I see and have seen, because you'd never expect a tax on a debt repayment, but just be conscious of it. Now, another area to be mindful of is that if you own a principal place of residence in Australia, so if you're an American living in Australia, and you have a principal place of residence, and you're liable for US taxes. So Australia, if you're selling an Australian residence, and it was your primary residence all the way through ownership, and you sell it as a tax resident of Australia, there's no capital gains tax on principal place of residence. However, under US tax law, you potentially will pay some capital gains tax. And the way it works is that if the property was your principal place of residence for 2 of the last 5 years before sale, you get a $250,000 USD exemption from the capital gains tax. But any gain over and above that USD $250,000 per taxpayer, so if there's 2 of you and you're both US tax residents and own it jointly, it's 250,000 each. But the amount over and above that threshold of exemption is taxable as a capital gain in Australia. So many of you that are living in Sydney or Melbourne or some of those states that have had serious capital gains appreciation on properties may fall into that bracket. And the other thing as well is that everything is converted into US dollars. So the initial purchase and the sale would be converted into US dollars. So the currency movement can work for or against you in that calculation of capital gains tax on the sale of a principal place of residence in Australia. Then on the Australian side of things, you need to be really careful with Australian property. So this is looking at how Australia will tax you. So this is looking at if you're an Australian living in the US or a US citizen that's buying a property in Australia but intend to go back to the US at some point and become a non-resident for Australian taxes, then the tax treatment on property is very different. So I'll go into this on the next slide. So this is how Australia treats property. So first and foremost, if you're a resident and you have an investment property in Australia, then the capital gains tax is treated like any other capital asset in your personal name, where there's a gain, and that is that if you own the asset for more than 12 months, you get 50% that's disregarded from any gain on eventual sale, and then you pay tax on half the gain. So in that case, if you're a resident all the way through ownership of an investment property in Australia, then you will only pay tax on half the gain. So really the maximum tax rate, given that the highest marginal tax rate in Australia is 47%, the maximum you can pay on the total gain is 23.5%, because that's half of the highest marginal tax rate in Australia. And on a principal place of residence, it's nil. So for the period of time that your house is considered a principal place of residence as a tax resident of Australia, there's no capital gains tax. It can go from 1 million to 10 million in an extreme example, no capital gains tax. However, when you're a non-resident for Australian tax purposes, the period of time that you're considered a non-resident is taxed at higher tax rates on any gain attributable to that time. So you're looking at a tax rate of 30 to 45% because you don't get this 50% discount on capital gains. You're assessed on the entire gain. And as a non-resident, the first dollar you earn is taxed at 30%. So you don't get the lower tax thresholds. You pay tax on the first dollar you earn at 30%, and it goes up to 45%. So this is also true of an Australian living in the US, having an investment property in Australia, then coming home and selling it. It's that period of time that you were a non-resident is going to be assessed at these more or higher tax rates from an Australian non-resident perspective. So it is it's certainly a higher tax rate for non-residents. And then be careful on the principal place of residence. Now, this is something that came through a few years back, and it's a very harsh piece of legislation in Australia. That a principal place of residence, if it's sold as a non-resident for Australian taxes, you don't get this exemption for capital gains tax. And it's also backwards looking. So let's say, as an example, you bought a principal place of residence in 2015. You lived in it for 10 years until today. You move out and you move to the US. and you then sell the property when you're a non-resident for Australian tax purposes, you'd be assessable on that full gain. They would look back even that period of time that you're an Australian resident and it was your principal place of residence, and they tax you on the whole gain because you are not entitled to the principal place of residence exemption as a non-resident of Australia. It's very harsh, but it's something to be really careful of and consider selling your principal place of residence if you're leaving Australia and need to sell the property as a non-resident for Australia. Now, if you're going to be returning and you're very, very confident you're going to return and come back into the Australian tax net, then you can sell and you typically will get the exemption for capital gains on the period of time that your property is considered a principal place of residence. But it's something you really want to get some advice around from an accountant or financial advisor that understands this space. Similarly, on income, so rental income on an investment property, the marginal tax rates. So as a resident, you're looking at 0 to 47% because you get the lower tax thresholds. It's marginal tax rates in Australia. As a non-resident, you are assessed on the first dollar at 30%. And then you go up to 45% because you don't pay the Medicare levy surcharge as a non-resident. So, yeah, you will pay a higher tax rate on that lower level of income on property under Australian taxes. Now, if you're a US tax resident, again, this all gets assessed on the US tax side of things, but you can use any taxes typically paid in Australia. Australia will get first taxing rights on Australian domiciled property and then offset it against US federal taxes, but be careful again about the state-based taxes. Some overarching considerations and things to watch out for. Again, watch or be very, very careful about selling that principal place of residence as a non-resident for Australian taxes. That can be a very, very costly transaction and mistake that many people aren't aware of. And it factors into your thinking. If you are, a US citizen living in Australia and you're thinking, I'm only going to be here for a couple of years and I'll probably move back to the US, maybe I'll just buy a principal place of residence in Australia. That's a consideration that you need to think about of how that may translate into tax. Then, yeah, waiting to be a tax resident of Australia before selling either your existing principal place of residence or one that has been a principal place of residence in the past. That's a very important consideration. Now, for an Australian living in the US that has a property in Australia that has a loan against it, and if you're in a negative gearing position, which is what they call it, which is where your interest repayments and your expenses against that property are more than the rental of that property. So you're actually making a loss on the property year to year on the income and expenses. Any losses, because you won't have other income in Australia to offset it against, presumably, because you won't have an accessible wage income or employment income to offset it against, you can actually carry that forward to future years in Australia, so that if you then move back to Australia and you're earning accessible income again, you can then use that loss against the property from previous years on income loss to then offset against future income, and that includes employment income in Australia. That's a pretty unique Australian tax consideration and benefit from the Australian tax system. So that's something we think about and put into our planning for certain clients as well. And then you've got to be careful. We're mostly talking about Australian assets, but you've got to be careful as well of selling a US property and returning to Australia. Often Australia is only looking at the gains on a property from the day that you become a tax resident again of Australia. And the US is always taxing US property under US tax codes, but it can be a consideration if you're in certain high taxing states and you return to Australia again. certain state-based taxes won't be offset against Australian federal taxes. And there can be some nuances as well to how that tax is offset against Australian taxes. So it is something that you should get some tax advice around because it can get a bit more complicated on kind of longer term US properties when you're a long-term Australian resident. But I thought we would just flag that without going into too much detail on that because it's a little bit out of the scope of the presentation today, but just something to flag and be mindful of and certainly get advice around it because it can get complicated. Moving along to superannuation. So this is one of the obviously very popular structures of investing in Australia. And it's, you know, superannuation from an Australian tax standpoint is a fantastic tax structure where the earnings are taxed at a maximum of 15% in Australia within the super fund. It becomes tax-free earnings in retirement, typically when you commence an account-based pension, tax-free on drawdown in Australia. So that's why superannuation around the world is considered one of the best retirement vehicles there is because you've got the ability to get a lot of money in quickly and the tax benefits are outstanding. But when you're paying US taxes, it can get very, very complicated. Now, it's very grey how US taxes are applied to superannuation because it's not mentioned in the double tax treaty, believe it or not. So it's not very clear that the US doesn't specifically come out and say this is exactly how we're going to treat Australian superannuation for US tax law. So you will find variance of opinions out there, and it's no one's fault. It's not the accountant's fault. It's just that it's just not clear. So the first thing I'll say in the red text up there is that you should speak with your US accountant on any superannuation strategy to make sure that you understand how they're going to treat any strategy you've got with your superannuation. It's something we can't underline enough. So we are going to go through today just some of the common treatments, but please don't take this as advice because there are variances of this, and this is just what we see from working with the various US accountants that we work with that assist our clients. So firstly, if you're a US citizen living in Australia, or if you're in the US and your employer is making contributions into superannuation, under Australian tax law, that's typically seen as a concessional contribution, that what your employer is contributing, and that means that it won't go on your tax return in Australia. That typically won't hold true in the US. The US doesn't recognize that. It's not a deductible contribution going into superannuation. It's typically assessed on your return as remuneration, just like any other part of your wage or remuneration package. So that's an important first point. Then there's two prominent ways that superannuation would be treated from a US perspective. One is an employee benefits trust, which is essentially a fund that's been set up by your employer effectively to make contributions into the fund. And most of the contributions within the fund are made up of contributions that have come from your employer as the mandated amount that needs to be made into superannuation. So that's a really important point. And that means that with superannuation, that unless you're a very high income earner, usually the earnings within your superannuation won't be taxed until you draw down from your super. And that's when, under US taxes, that you would pay income taxes on the drawdown of super. So that's a little bit different to the Australian tax system. It's meant to be tax-free drawdowns, but the US tax code will want to tax your super on the investment earnings at some point. So very high income earners may potentially pay tax on the increase in value each year on your superannuation, but that's something your accountant would confirm with you. And that means if you do that, then the drawdown, you won't be double taxed under US tax law. It's essentially if you've paid the tax on the earnings, you won't pay tax on drawdown. But most people, it would be on drawdown. That's when you're taxable on superannuation when it's an employee benefits trust. Now, this last point is that when it's one of these employee benefits trusts, Emily talked about passive foreign investment company treatment and how managed funds and exchange traded funds are treated when they're owned in your personal name. Most super funds won't have this problem. So if you think of most super funds, they're going to own, you might be in a balanced option or a growth option within your super fund. That's a managed fund. Usually that won't be a problem from a US tax point of view because they're not looking through to see what's actually owned within your super fund, unless you trigger a different treatment in the US, which we'll go through in a moment. So the second type of super fund or treatment we see is a foreign grant or trust from a US tax perspective. So this is where the US will look at your super fund as a foreign trust, not a deferred employee benefits vehicle that's been set up for your retirement by your employer. So under this treatment, essentially the US is going to look through the structure, treat it as a foreign trust, and then tax all the earnings within your super fund as though they were earned in your personal name. There's a far more costly return that you need to do on the US tax filing. It's a separate return to your personal tax return, and it can be quite costly. And it opens up some other issues, which we'll go through in a moment. But the reasons why this gets triggered, again, variance of opinions, and there's reasons why, other reasons aside from what's on your screen there. But the prominent ones we'll see quite often if it's a self-managed super fund. So where you've gone out and created your own super fund and you're the trustee of your super fund, or you've got a company that you're the director of that's the trustee of your super fund. Under most accountants that we've seen, that would be perceived as a foreign grant or trust from US tax purposes. The other thing that we often see is that where you've made a major lump sum personalized voluntary contribution into your super fund that is over and above what your employer has ever contributed to that scheme, then that can be a trigger for a foreign grant or trust. So in an example, you've got the ability to put $360,000 into superannuation of after-tax money in one hit if you wanted to in Australia in most instances. And if your employer had ever only contributed $200,000 of the mandated amount that they need to be contributing, you've put in more than what your employer has ever contributed to that fund, and that is likely to be a trigger for this under most of the accountants we work with. So it then converts, very strong possibility of converting your super to a foreign grant or trust. So when that's the case, what happens is that the actual investments that are owned within the super fund come into view, and the ATO would be the IRS would be looking at what's actually owned within that super fund and saying, okay, what are the investments? Are they PFIC investments, which Emily went through before? So the managed funds, ETFs that are domiciled outside of the US or in Australia. Any indirect type investments would then have that treatment that Emily talked about, where it's a far harsher US tax treatment, extra filing that you need to do, and it can get very costly quite quickly. So you would want a very, very good reason to trigger this, I guess, is the overarching message, and you need to be very careful about triggering this. There can be examples where it does make sense to trigger it, but they're very, very limited, and you definitely want advice from your tax specialists and advisors that understand this space before you would trigger this. So it's a very big consideration, and it's very hard to unwind if you do trigger this. So that's an important concept. But I'll stress this again. Superannuation is a grey area. I know there's a lot of frustration out there on superannuation and not having a clear treatment. It's not the accountant's fault. It's not the financial advisor's fault. It is purely the US have not come out and said explicitly how Australian superannuation to be treated, and it doesn't fit into any of the US retirement schemes, and there is just ultimately uncertainty and difference of opinions out there on how it's to be treated. So um, some strategies again that we look at and think about with US taxpayers. So if you're an Aussie living in the US and you're going to be coming home to Australia, then it probably doesn't make sense for you to be contributing into your superannuation whilst you're living in the US. There'll be opportunity when you come home. You can do what they call catch-up contributions, which is a very effective strategy we use for a lot of Australians coming home. And so you can actually go back previous years of pre-tax contributions and utilize the unused portion of your pre-tax contribution limits for up to 5 years, as long as your balance is under $500,000 of your total superannuation holdings in Australia. You can do the after-tax contributions, as I mentioned, of 360,000 in one go. You can play catch up pretty quickly with superannuation in Australia, and if you can extract yourself from the US tax net and just worry about Australian tax law, it's far safer to do that. Be careful of the triggers for foreign grant or trusts, as we were just talking about. Again, um, if you're a US citizen living in Australia, many of you have married Australian partners that aren't part of the Australian tax net or are in relationships that you're handling finances together, then you could consider whether you use more um, of your partner's superannuation thresholds to really make the most of what superannuation has to offer from a tax and investment perspective. Because if they're out of the US tax net and not having to file US taxes, then it's far simpler. From their perspective, they've got far more options available without triggering some of the issues around US tax purposes. So thinking of things holistically as a family unit, where there's that option, that's something to consider and something we look at for a lot of our US citizen clients living in Australia. So if you do have a self-managed super fund and you are a US taxpayer, then making sure that you adjust the investments according to that US tax treatment and going very direct into very direct equity type investments and um, avoiding the passive foreign investment companies that we were talking about before. So we do look after some SMSFs for US citizens and you can do it. It's more costly, but there's just a few things you need to be aware of to make sure that you don't end up paying a lot more tax from a US perspective. Beware of superannuation rollover. I'll mention it's a very grey area, and you'll find variants of opinions out there. But even that can, in some opinions, be a taxable event for the US as well. So just flagging that out there. That you just need to be careful, and as I say, always check any strategy you're looking at, even as onerous as moving a super fund from one to the other, to see how the US accountant's going to treat it, because it varies drastically. Very quickly, so different structures in Australia. We've gone through superannuation, so we won't spend any more time on that. Family trusts are a very common vehicle to invest in Australia. There's a lot of benefits in how you distribute the income from a trust to different beneficiaries in your family unit. So it can be a very tax effective vehicle to invest via in Australia, but also there's some asset protection considerations as well. So a lot of business owners will look at owning personal assets or business assets through a family trust. So that's important consideration as well. But just be mindful that the benefits from a US perspective, from a tax side of things, are often dissipated because the US will treat a family trust differently to the way the ATO will treat it. So often there's look through on a family trust, and the earnings are often attributed to the person that's contributed. Very complex area of tax law. Again, making sure you've got specialists involved and specialists that understand Australia. So US tax specialists that get Australia, because family trusts are very different in Australia compared to other trust structures in other parts of the world, especially the US. So just being mindful of that. And then again, if you're a US citizen living in Australia, and you do have a non-US citizen spouse, as we were talking about, you could think about some of these problem areas for US taxes. So your principal place of residence, if that's going to be tax-free from an Australian tax perspective, but potentially taxable in the US on
Mm,
sale. There's consideration of whether the ownership goes in the non-US taxpayer's name. Assuming you're going to stay in Australia, that can shield from future capital gains that might be owed to the US. There's also consideration around the PFIC investments or managed funds, ETFs, having those in your non-US citizen partner's name can be an effective strategy as well. So all these things that we're talking about, there can be, if you've got a non-US taxpayer in your family unit, there's ways of structuring assets and thinking about who owns them to navigate some of these issues. But be mindful as well that in Australia we can't file as a couple, so you can't file jointly. In the US, you can do the married filing jointly, and often it won't matter as much whose name assets are in. But in Australia, it's a very important consideration from a tax planning perspective whose name assets are in. So, if you're a US taxpayer and your spouse is on the highest marginal tax rate and you're on the lowest marginal tax rate, you've got to consider very carefully of whether you put the assets in your partner's name because every cent of earning is going to be at the highest tax rate. So you've got to consider things from both angles in that. Um, you know, it's looking at how we can maximize your financial position across both tax codes and source the best investments available to you. So it's important to look at everything holistically and pay the least amount of tax that you can legally and also set up investments in the best way to achieve your future financial goals, which is what we're all about at Apt Wealth. So very quickly, in terms of Apt Wealth, we do have a big team in the background so Emily and I are senior advisors and deal with our clients, and we're very knowledgeable about investments, but we've got a very experienced team of analysts and professionals that are watching this stuff every day and picking the best investments for our clients. Because of our US Australian clientele, they're fully across these considerations around US Australian investments and what a PFIC is and making sure we navigate these issues. So we come up with very bespoke solutions. But given the size and scale of Apt Wealth and that we manage $3 billion worth of wealth in super and personal wealth portfolios, that we're directly recommending the allocations and how they're split, that there's a lot there in the background that Emily and I can call upon and a lot of expertise. It's not us sitting there picking the investments. There's a lot of solutions there to make sure that we're selecting the best investments and continuing to monitor those. And then the broader advice services. So as a firm, we're really there to pick out, what is the best strategy, piecing all of this together. These things that we're talking about, what assets to own, in whose name or structure to own the assets, where do we own the assets, and ultimately, how do we put everything together in the best way to achieve your short-term and long-term financial goals and continue to stay on track and make good, smart decisions. So we're there to put together a strategy and then there to make recommendations on assets typically here in Australia and continue to navigate the changes that will invariably happen in your world and the financial world. So all of those services, super and retirement planning, what to do with your surplus cash flow and how to manage your cash flow, investment management, all of those areas that we talked about. And then through our professional partners, we've got life income protection insurances that we can set up here in Australia. There's legal services that we can organise through our legal solutions. We've got mortgage brokers that work with us and work within Apt Wealth and can work with complex needs that often arise through having cross-border incomes and US Australian financial setups. And then we've got close professional partners that we call upon on the accounting side of things that are specialized in this space and can look after US Australians with their taxes and essentially we're there to string all this together and make it as consolidated and seamless and make sure that all the professional services are looked after as well as we possibly can and with as little stress and you know um, hassle from your side of things as well. So that's that's basically it. So I think we've gone through the structured part of this presentation today. I can see there's quite a few questions with the Q&A. So we'll go through some of these with Emily and myself. So um, first question is with all the political and government changes in the US, if there's any changes to the tax and investment rules that could affect dual citizens living in Australia. Very, very difficult to know, just given the uncertainty of the political climate. It is more unpredictable than previous administrations. I think that's very fair to say. It was an election promise, or it was mentioned. I don't know if it was a full promise, but there was mention of tackling citizenship-based tax. But it's gone very quiet, and I wouldn't be holding too much hope on that, to be honest. But it's something we're watching, and at the moment, not much has changed. But it's yeah, it's something we're always watching, and we'll certainly adjust strategies accordingly. Uh, Emily, any ones that you wanted to tackle in? So there's one from Michelle who's mentioned about Australian tax treatment of a US 401k. So that's a very good question. And typically, and there's a little bit of conjecture around this, but there's been some private rulings that has basically said that from an Australian perspective, any contributions into a 401k are not taxed. That's treated as the capital of the 401k. And then it's the component of the 401k that represents the investment earnings that would be taxable in Australia. So in an example where 50% of your 401k was attributable to the contributions that your employer put in, and then the rest was the growth of the portfolio. So you've got half contributions, half investment earnings, then it would be half of the drawdown would be taxed as assessable income in Australia to represent that earnings component. But do check with your Australian accountant, because we have seen some slightly different interpretations, but there are some very clear private rulings that have been set out by the ATO in recent years on that aspect. But private rulings aren't binding on everyone. So that's what we've seen from our accounting partners.
There's a question here from Kyle. Can you confirm exact definition for where voluntary contributions exceed employer mandated contributions, accidentally triggering the trust structure in super? Is this on the pre-tax amount? Is it each year or the entire lifetime of the super account? So it's where you're putting additional contributions into superannuation over and above those of your employer. So it could be for the lifetime of the superannuation account, but it really depends on how long you've been in the Australian superannuation system. You could have had $300,000 worth of employer contributions over many years, or you could have just moved to Australia and you've only been in the system for a couple of years. So really the strategy is going to vary quite dramatically. We might have to take it year by year. So for example, if your employer is putting in $10,000, not exceeding that $10,000 amount in voluntary contributions, or we may be able to determine how much has gone into the account over the lifetime of the account, and determining, okay, can we put lump sum contributions, taking advantage of things like non-concessionals or catch-up contributions. But as John said, the strategy is going to be very personalised, and you should definitely seek advice from a tax accountant or a financial planner before making any additional contributions into superannuation.
Yeah. Perfect. Thanks for that, Em. And it is a grey area, but yeah, there can be the ability, if you can demonstrate previous years of contributions from your employer, and that's kind of mandated. There can be the ability to put a bit more in to stay under that kind of lifetime threshold. But as Emily mentions, it's very grey, and always check with your accountant because they may have a slightly different interpretation. Although that one is much more universal, we find. But so the capital gain. So there's a question about the capital gains on a principal place of residence. So that's essentially that, because if you're a US citizen living in Australia, you're still going to be accessible on your worldwide assets to the US. You're still a US tax resident, and basically the house in Australia is assessed in exactly the same way as a principal place of residence in the US would be. And under US tax law, the principal place of residence is not a fully exempt asset. You get an exemption of $250,000 of gain, and it's the gain over and above that $250,000 that you would then be taxed at for capital gains rates. And that's the way it works in America for an American selling a property in America. And that just gets applied to Australia as a US tax resident. So, and you need to have owned a property 2 of the last 5 years as well. So, unfortunately, it's just a bit of a mismatch between the tax systems and what America, how America treats a principal place of residence versus Australia. And that full exemption doesn't apply on American taxes, unfortunately. Might be time for one more question. I'll just have a look. So the debt repayment issue on HEX or a lump sum, I haven't seen that. So the question is whether the debt repayment issue is a problem with HEX, which is the education loan essentially that you have in Australia for university. I haven't seen that being a problem, and I haven't seen that being applied. I would just double check it with your accountant because I think theoretically the same concept could apply, but I've just never seen that actually applied. And it's kind of the thing as well that I would always check this with your accountant with a lump sum, because it doesn't always get applied. And just check with your accountant on what their treatment would be. But it is something to flag because we obviously don't want anyone getting a nasty shock after repaying a loan, which is just good financial principle to do, and you wouldn't think there'd be a tax problem, but there can be. I think that is all we had time for today. So we might leave it there, and I think we've got pretty well all the questions, but if there's any that we did miss, please reach out and we'll see, if either we can assist or we can direct you into the direction of one of our professional partners who might be able to help out as well. But thank you all for joining. If you think we can be of assistance, you'll get an email from us, which will have our details, and you're most welcome to reach out. But thank you for joining, and we hope you enjoyed the content, and we look forward to seeing you all soon.